Pull $50,000 from your IRA the year you settle in Portugal, and the IRS can still claim the full $50,000 as ordinary taxable income. The Foreign Earned Income Exclusion does not reduce that bill by a single dollar. Not one. The IRS. Not that exclusion. Not your new address. The United States taxes its citizens on worldwide income no matter where they live. That exclusion was written for Americans still earning wages abroad. You are retired. And depending on the income tax treaty between the United States and the country you chose, your new home government may issue a separate tax notice on the exact same withdrawal. Traditional IRA and 401k distributions are treated as ordinary income by the IRS, regardless of your mailing address. Your host country may treat that same money as resident income. And the tool that is supposed to prevent paying two governments at once has limits that most domestic accountants have never read. Every year you live abroad, every taxable distribution from your traditional IRA or 401k. Same two-layer calculation for the rest of your retirement. The IRS taxes it on the way out. Some countries tax it on the way in, and the offset mechanism depends on treaty language that is not the same in every country and not the same for IRA accounts as it is for other income. I am your guide to the retirement decisions that cost nothing to understand and everything to misread. In the next 15 minutes, the IRS claim that travels with you, the Foreign Earned Income Exclusion trap, the credit ceiling, and the Roth window that can narrow once you establish tax residency abroad. Part 5 is the one most people ask about only after they have already moved. Getting there before you sign anything is what changes the math. Before Part 1, if careful retirement tax planning like this is useful to you, tap like and subscribe right now so the next one finds you. Part 1. The IRS follows your IRA across the border. The United States taxes its citizens on worldwide income regardless of where they live. That is the foundation of everything we are covering today. Move to Spain. Move to Mexico. Move to Thailand. You still file a U.S. federal return every April. Your IRA distributions still appear on that return as ordinary income, taxed at whatever rate your income and filing status produce under the same brackets that applied when you lived in Ohio or Arizona. This is citizenship-based worldwide taxation, and the United States is one of the very few developed countries that operates this way. Most countries tax based on residence, leave, and your obligation to that government fades. The U.S. follows its citizens. That one rule does not change when you take your retirement savings abroad. So before you read an article about retiring cheaply in Europe or tax-free living in Central America, absorb this. Moving abroad changes which rules touch which dollars. It does not remove the U.S. claim. For traditional IRA and 401k distributions specifically, the U.S. claim is identical to what it would be if you had never left. Ordinary income at your marginal rate, subject to your filing status and any other income in your picture. The address on your tax return is not what determines your bracket. A married couple drawing $50,000 a year from a traditional IRA keeps paying U.S. income tax on that distribution. Their marginal rate follows the same tables, the same brackets, the same calculation. That bill travels with them. Part 2. The exclusion that does not apply, and why so many retirees assume it does. Here is the specific mistake. It happens at kitchen tables, in online expat groups, and in articles that use the word exclusion without explaining what it actually excludes. The Foreign Earned Income Exclusion, the FEIE, allows a qualifying American abroad to exclude up to $132,900 of earned income from U.S. federal income tax in 2026. That is the number people read. That is the number that sounds like protection. Notice the word, earned. Wages, self-employment income, money you're actively working for in a foreign country. That is the entire list. Here is what the FEIE does not cover. IRA withdrawals, 401k distributions, pension income, Social Security benefits, rental income, dividends, and interest. Every form of retirement income that most Americans actually live on once they stop working, none of it qualifies as earned income under the IRS definition. None of it can be excluded under the FEIE. If you're 64 and fully retired and taking $40,000 a year from your traditional IRA while living in Costa Rica, the FEIE reduces your U.S. tax bill by exactly zero. To claim the FEIE at all, you must also meet one of two qualifying tests: either 330 full days outside the United States in any 12-month period, or genuine long-term residency in a foreign country for an entire tax year with real evidence that you intend to stay. You cannot winter abroad and apply. But even for those who meet the tests, if your income is entirely from IRA and pension distributions, the exclusion does nothing for you. It was designed to encourage Americans to work abroad. It is not a retirement income protection. These two things look similar on a web search. They are not the same rule. Part 3. When your host country adds its own bill. If the United States were the only government taxing your IRA distribution, the picture would be uncomfortable but predictable. You pay U.S. rates on U.S. income, exactly as if you had never moved. The problem is that most countries where American retirees settle also tax their residents on worldwide income. Spain, France, Germany, and Italy all operate this way. When you become a tax resident in one of those countries, you are generally required to report your worldwide income, including your U.S. IRA distributions, and pay local income tax on it. That is the second layer. This is where two retirees drawing the same amount from the same type of account can end up with two very different bills from two different governments. Whether your host country can actually tax your IRA distribution and at what rate comes down to one specific question. What does the income tax treaty between the United States and that country say about pension income? And more specifically, does your IRA qualify as pension income under that treaty's language? U.S. income tax treaties typically include an article on pension income that assigns taxing rights between the two countries. But those treaties were often written when the dominant retirement vehicle was the employer-sponsored defined benefit pension, not the individually owned IRA. Some treaties have broad language that clearly covers IRAS and 401k plans alongside traditional pensions. Others define pension more narrowly, covering employer plans and government retirement programs, but leaving a gap for accounts you opened on your own. When that gap exists and your host country has a domestic rule that taxes residents on worldwide income, it may classify your IRA distribution under a different article of the treaty and apply its own rate. There is also a protection that runs only in one direction. Most U.S. income tax treaties include a saving clause, a provision that lets the United States continue to tax its own citizens regardless of what the treaty says. The treaty protection limits what your host country can do to your income. It does not limit what the IRS can do to you. Think of it as the IRS keeping its seat at the table, no matter what the treaty says. Portugal's non-habitual resident program offered qualifying retirees a flat 10% rate on foreign pension income years. That program closed to new applicants at the start of 2024. The replacement regime does not carry the same benefit for IRA and 401k distributions. Articles from before 2024 that describe Portugal as a tax-efficient destination for IRA income are describing a door that has already closed. The danger is not choosing to live abroad. The danger is assuming that one government's tax treatment cancels the other government's claim on the same money. Part 4. The foreign tax credit, and the two cases where it falls short. The mechanism designed to prevent you from paying two full sets of taxes on the same dollar is the foreign tax credit, filed on Form 1116. In many situations, it works exactly as intended, but there are two specific cases where it does not, and both are common enough that every American considering a move abroad needs to understand them. Case 1 is the situation that catches even careful planners off guard. Case 2 is the one almost nobody sees coming until they are already filing their first return from abroad. Case 1. The treaty gap. 2 retirees, same $50,000 in annual IRA draws, for illustration at a 20% federal rate in the U.S. Robert lives in a country with a comprehensive income tax treaty with the United States that explicitly covers IRA and 401k distributions as pension income and includes treaty resourcing provisions. His host country taxes that distribution at 18%. Robert files Form 1116. In that clean treaty case, the foreign tax credit offsets the U.S. federal tax he owes on that same income. He ends up paying effectively at whichever rate is higher, his host country's 18% or his U.S. federal rate, but not both in full. This is the system working correctly when the treaty covers IRAS and the resourcing rules apply. Carol's situation is different. Her country's treaty pension article was written before IRAS existed as a significant vehicle. Her host country classifies the IRA draw as other income and taxes it at its standard resident rate. Both governments claim the same money. She files Form 1116. The credit is not a dollar-for-dollar match. It is capped by a formula on Form 1116 that ties the usable amount to the ratio of foreign to total income. Under the sourcing rules for IRA distributions, which are U.S. source income by default, the usable credit may be less than the foreign tax she paid. She does not pay both rates in full, but she pays more than the simple formula suggests, and the excess is not refundable. Case 2. No treaty at all. The United States has income tax treaties with more than 60 countries. A number of popular retirement destinations have none. Without a treaty, the U.S. taxes your worldwide income as a citizen, and a host country that taxes its residents on worldwide income can also tax the same distribution. The general foreign tax credit is still available under U.S. law. You do not need a treaty to file Form 1116. But without treaty language defining income categories, how much of that credit you can actually use depends entirely on the income basket rules and your specific filing picture. Getting this wrong costs real money. Getting it right requires a professional who has run this calculation before. The difference between Robert and Carol is not their income or their withdrawal amount. The difference is one sentence in a treaty most people never read, and what that sentence says about accounts that did not exist when the treaty was signed. Part 5. What you can do before you move. The first 4 parts today were about the problem. This part is about what you can still do about it, and the window for acting closes the moment you sign a lease in another country. The strategy centers on the Roth. There is a window of action between now and any international move that most people do not use. On the U.S. side, qualified Roth distributions are generally not taxable income on your U.S. return. They generally do not appear in adjusted gross income. They do not count toward provisional income for Social Security taxation. The IRS does not tax a qualified Roth withdrawal that meets the holding and age requirements. If you convert traditional IRA money to Roth before you leave the United States, you pay ordinary income tax now, at your current U.S. rate, and future qualified distributions are clean on the U.S. side of the ledger. The caveat you need to hear before you act: many foreign countries may not recognize the Roth account's tax-exempt status. They see a distribution and apply their own domestic rules. A Roth withdrawal is often treated the same as any other retirement account distribution for local income tax purposes, because the U.S. tax treatment of your internal accounts is not their law's concern. Many countries do not honor the Roth's tax-free status at the border, though the exact treatment depends on your destination country's domestic law and any applicable treaty provision. So converting to Roth before you move can eliminate one layer of the double tax exposure, the U.S. layer. It does not automatically eliminate the foreign layer. Whether it does depends entirely on your destination country's domestic law and its treaty terms for retirement distributions. Countries that use a territorial tax system, taxing only income sourced within their own borders, change this calculation. In a territorial tax country, your U.S. IRA distribution may fall outside local taxing jurisdiction, but only if that country's domestic rules classify U.S. retirement distributions as foreign-sourced income. Each country defines that differently, and some territorial systems still tax foreign pension income paid to residents. For retirees in a country that does treat it as outside local jurisdiction, a traditional IRA draw triggers only the U.S. tax. A qualified Roth distribution can be clean from both sides. That combination, Roth accounts and a territorial tax destination, is one of the cleaner configurations for reducing the two-layer problem. Whether your specific destination country operates this way for U.S.-sourced IRA income requires verification with a cross-border tax professional before you count on that treatment. The Roth conversion window is typically most favorable in the gap years between full retirement and the start of required minimum distributions, when your income is at its lowest and your marginal rate is at its minimum. If you are currently in the 12% bracket and expect to be pushed into the 22% range once distributions begin, converting at 12 cents on the dollar now avoids paying the higher combined rate later. If you're also planning an international move, those planning windows often overlap. Converting before the move, not after, is when the math works in your favor. The closing rule, and the one question to ask before you sign anything. One rule from today: the Foreign Earned Income Exclusion protects what you work for in a foreign country. It does not protect what you saved in a retirement account. Your traditional IRA distribution follows you overseas with full U.S. ordinary income treatment. Whether your host country taxes the same money on top of that depends on the specific treaty article covering pension income, whether your IRA qualifies under that language, and whether the foreign tax credit limitation rules allow you to fully offset what both governments charge. This is not financial advice or tax advice for your specific situation. Every income mix, every destination, and every treaty is different. What we covered today is education, the education that prevents the expensive surprise. IRS Publication 54, the Tax Guide for U.S. Citizens and Resident Aliens Abroad, is a free starting point. It does not replace a cross-border professional who has filed Form 2555 and Form 1116 before, but it helps you arrive at that first meeting with the right questions. Before you sign a lease or a purchase contract in any country, ask your advisor one specific question. Does the pension income article in the treaty with this country explicitly cover IRA and 401k distributions? And what does my foreign tax credit limitation look like given my projected annual withdrawal? If they cannot answer that, find one who can. Never choose a retirement country before you know how your IRA dollars are taxed on both sides of that border. The research is free. The surprise, once you are already there, is not. In the comments, type the word treaty and the country you're considering: U.S. Mexico, U.S. France, or wherever you're actually planning to go. It tells me which breakdown to do next, and it helps more people in your situation find this channel. If this answered something your current advisor has not covered, the like button helps this reach more people who need it. Subscribe for plain English retirement and tax content. No fairy tales, no fine print buried at the end. See you in the next one.